if you look back at September 2011, yes, the arguments for gold were very, very strong. You know, it looked like Europe was potentially falling apart, but there were the debt defaults or the debt crisis, remember? And it looked like the whole European Union potentially could break up. So when you say what's different, and we never use those words, what's different this time, of course, the four most dangerous words in the investment lexicon. It's different this time. But there's no question that in 2000... Good question. I think what's obvious now about gold that was true 3 months ago but wasn't obvious is, you know, there's a really major important new buyer come in, and that's Tether, which is, you know, Tether, the big stablecoin company. So if you look at the last 2 quarters, that's the second quarter going all the way back to April, the second quarter and the third quarter, Tether purchased more gold, physical gold, than any other central bank. And by a meaningful margin, particularly in the third quarter, by a meaningful margin. So this is a significant new buyer with deep, deep pockets, right? I mean, remember the stablecoin, the US stablecoin that they've been pocketing their 4% interest all the way along. So they have very deep pockets. They are ideologically driven, both on Bitcoin and on gold. And I think they're going to continue to be big buyers of gold. So when you see a new buyer, then we also have, of course, the central banks where the buying has come down a little bit from the highs last year, but it's still very, very high, and in fact picked up in the last quarter over the previous quarter. And it's very diverse. It's not just, you know, for a long time people just kept going on about China. It's not just China, as you know. It's Poland, it's Kazakhstan, it's you know, a whole bunch of countries are buying gold on a consistent basis. And the sentiment in the US, I think, is definitely beginning to turn, or in North America, is definitely beginning to turn, no question about that. It is still not in any way a flood of buying, and it's certainly far from sort of some kind of mania. We are not anywhere close to that at the moment. And so when people talk about gold being in a bubble, that's just nonsense. Because you can't have a bubble without broad public participation, which we don't have. But sentiment is changing. And I think also as the Tether story gets better known, what Tether's doing, then that will probably bring a whole new group of buyers into gold. So no, I remain very, very positive on gold, very positive. And you know, it's interesting. I heard Juan Santori, who's the head of special projects, I think they call it, for Tether, but he's the one that's really driving this gold, or in charge of this gold drive. He said their biggest issue, you know, they have a gold stable coin now. You probably know that in addition to the US stable coin, the gold stable coin is far, far smaller. He said their biggest issue is actually making sure that they can get the steady supply of physical gold to back the stable coin, given the growth that they are expecting from that coin. Which is, you know, he said they're looking at it to have the same kind of growth trajectory as the US stable coin. And so they're doing all sorts of interesting things. One of the things they're doing, for example, they've approached several gold mining companies for offtake agreements. Now, we don't need to get into the weeds here, but I mean, I think with the gold market, there is much less reason, both for buyers, but also for the miners, to enter offtake agreements than there is in copper or zinc or, you know, some of those other base metals and other resources. particularly the more illiquid ones like lithium and rare earths, where offtake agreements are essential. It's not true in gold because a producer can sell his gold anytime he wants at the market price. But nonetheless, that just illustrates the thinking on the part of Tether to try to get long-term supplies of gold, which I think is very interesting.
While central bank gold purchases are below last year's record levels, they remain well above historical averages. More importantly, the buying is geographically diverse. It's no longer just a single country driving demand. Nations across Europe, Central Asia, and the Global South continue to add gold as part of a broader reserve diversification strategy. These institutions are not momentum traders. They are strategic allocators. Although some pause after sharp price moves, the long-term trend remains intact. Gold's role as a neutral reserve asset has only grown more relevant as concerns about currency risk and financial sanctions persist.
Yeah, no, interesting point. I think so. But what I would say is we really haven't seen that so far. Again, the central bank buying is less than it was at the peak a year ago, but it's certainly a lot more than the 5-year average has been. And there's no indication that it's slowing, but at some point it will slow for the reason you said. And also no one, whether you're a individual speculator, hedge fund, or whether you are the most price insensitive buyer, which is basically central banks who are price insensitive, you don't want to be made a fool of by buying at the top. And I think you've definitely seen that with China. There have been a few periods in the last year where China has backed away from the market after a strong move up. And I think that was probably just to try to see if the market would settle down. But there's been, and the other factor, of course, Vlad, is, if I can call you that, the other factor, of course, is central banks are diversifying their assets. We know why they're doing it. But they're diversifying their assets away from gold. So at some point, different banks will say, you know what, we've probably done enough now. You know, if the average across all global central banks for foreign reserves is now around 48% in the dollar, 21, 22%. I don't have the numbers for the numbers are always late. But 21, 22%, I'm guessing, based on the August numbers and then based on the buying we've seen in the last quarter.
Despite record prices, gold is far from a speculative bubble. True bubbles require broad public participation, and that simply isn't happening yet. Retail investors in North America and Europe remain largely focused on equities, where returns have been strong. Sentiment toward gold is improving, but it's still cautious, not euphoric. Exchange-traded fund inflows are modest compared to past peaks, and premiums remain subdued. This contrasts sharply with previous tops, where public enthusiasm surged well before prices peaked. Today's market is being driven by institutions and sovereigns, not headlines and hype.
Well, some banks at some point will say, you know, less than half is now good. And 20% in gold is now good. Other banks will say, we still want to get it down. And I mean, I ask a rhetorical question. If you're a country that is concerned about the valuation of the dollar, given the fiscal profligacy of the US government, with no sign that's going to change, and you're a little bit concerned to varying degrees about dollar weaponization, how much is too much? I would argue if you're concerned about that, 48% is still too high. So I think you're going to see continued selling of the dollar, but obviously as time goes on and the number goes down, that will slow. And you're going to see most of that dollar sales are going to go into gold. You know, that's central banks are diversifying a little bit, but you look at how much they own in the euro, which is the next big asset. It's about 20% right now. Gold is more than the euro. But after the euro, what is there? You know, there's some central banks that own a little bit of Japanese yen. There's one that owns a little bit of Australian dollar. But Saudi Arabia owns a little bit of silver. But basically, if you don't own gold, most of your reserves are going into, if you don't own the dollar, most of your reserves are going into gold. So yes, I agree with you. At some point it'll slow down, but I think at that point, other people will take over. Retail tends not to be bottom fishers, but tends to be momentum buyers and price followers. I'm surprised that we haven't seen more interest yet, to be honest. I'm quite surprised we haven't seen more interest yet from Western countries. And, you know, they look at Australia and say, oh, gold buying in Australia is up, gold buying in Canada is up. But if you look at it, and I don't mean to be, don't take this the wrong way, it's all Chinese and Asian people in Australia, in Canada. You look at the pictures of the lines outside the banks and the jewelry dealers. So Western buyers are really not in this market yet. And I think the reason for that is because the other assets are still doing well. You know, if your brokerage statement month after month that's invested in plain vanilla S&P ETFs, but month after month it's going up, you don't really start looking around at other assets.
Looking back at the 2011 gold peak helps put today's rally into perspective. On a logarithmic scale, the price acceleration leading into 2011 was far steeper than what we've seen recently. That earlier surge was accompanied by massive ETF inflows and visible speculative fervor. Today's advance, while impressive in dollar terms, has been more measured relative to the long-term trend. Sentiment indicators tell a similar story. Participation is rising, but excess has not yet appeared. These differences suggest the current cycle may still be in its middle stages, rather than approaching exhaustion.
If you look back at September 2011, yes, the arguments for gold were very, very strong. You know, it looked like Europe was potentially falling apart, but there were the debt defaults or the debt crisis, remember? And it looked like the whole European Union potentially could break up. So when you say what's different, and we never use those words, what's different this time, of course, the four most dangerous words in the investment lexicon is different this time. But there's no question that in 2011, although one could make a fundamental argument for gold, there was more speculative interest in gold back then. There had been more public interest in gold. So a couple of things. First of all, let's just look at price. If you look at the gold price on a log chart, not on an arithmetic chart, you see that in the couple of years leading up to 2011, as well as incidentally in a couple of years leading up to 1980, which were both big major tops for gold, the run-up in gold ahead of 2011 was much, much stronger than the run-up we've seen in the last couple of years. We think of the last couple of years as being a great run-up, and it is, of course, because the price is $4,000. It's not $1,800 anymore. But in geometric terms, in log terms, it's nowhere near the sort of rally they had in 2011. That's number one. But number two, if you look at sentiment indicators, look at the GDX, for example, and you see that in 2011, starting at about April, you had a huge inflows, and I mean huge inflows into the GLD and the GDX, huge inflows into those sectors. You had both of those ETFs trading at premiums more days than not, and meaningful premiums. You know, when the GLD trades at a 1.5 or 2% premium, that is big for a physical entity. You haven't seen that this year. You've had a pickup of buying, but not a massive inflow by any means. And you certainly haven't seen those major, significant, ongoing premiums in the ETFs. So I think the sentiment was completely different back then. And that's what leads me to say that even though you can certainly look back at 2011 and say, yeah, this was a top for all these reasons, I don't think you can make the same reasons today.
Silver behaves very differently from gold, and its supply structure makes it especially sensitive to demand shocks. Less than a quarter of global silver output comes from primary silver mines. Most is produced as a byproduct of industrial metals. This means supply cannot quickly respond to higher prices. Recently, large speculative players have focused on potential physical shortages, driving aggressive buying. Despite strong gains, silver remains far below its inflation-adjusted highs. With limited above-ground stockpiles and minimal central bank reserves, sustained demand could push prices sharply higher once retail participation accelerates.
Well, certainly, silver is different from gold, both on the demand side with the industrial demand, but also on the supply side, because there's very reasonably little, less than 25% of silver production is primary silver production. So most of it is byproduct of industrial commodities anyway. So if you have a fundamental slowdown and long-term, if you have a long-term fundamental slowdown in the economy, the demand on that side will slow down, but the supply of industrial metals will slow down, which means inevitably the supply of byproduct silver will slow down. The economy slowing, I think, would be a negative, but not a huge negative and not necessarily a long-term negative. Silver is really interesting to me because, yeah, we always think of it as being gold on steroids. It's the asset that, smaller retail people go to when gold gets too high. But I've been talking to some people who are intimately involved with the silver market, and it seems that, this time around, the major drivers of the last 6 months, and silver, of course, has well outperformed gold in the last 6 months, but the major drivers have been larger, have been hedge funds, have been speculators, larger speculators who are concerned about the potential for physical shortages. And so it's a kind of squeeze that's being put on, but not just by, one group like the Hunt brothers, but it's a lot of speculators thinking that we could see a shortage of silver for delivery that would lead to an explosive price rise. Let's not forget that the gold price, the silver price, even though it's done so well in the last 6 months and it's now at all-time nominal highs, in real terms, it is still significantly lower than where it should be, just in real terms. And even if you just use the government CPI number, going back to 1980, silver should now be at, $220 an ounce. So it's well away from its all-time real highs. So yeah, I think silver's got a lot more room to go. And the interesting thing to me is that everybody I talk to suggests that, again, retail buying has not really come into silver in a flood. I think that's beginning to happen. And when that does happen, that's probably what will push silver well over $100. Because, silver retail buyers tend to be, I don't mean this in a condescending way, but they tend to be real believers, all right? They put the gold bugs to shame. And so they will buy and they will hold. And the thing about silver on the supply side is there is no large stockpile of silver that can come to the market to keep a lid on the price. There are no banks with large stockpiles. There's no central banks with large stockpiles. We mentioned Saudi Arabia has some. I think Saudi Arabia is the only country in the world that I know of that has silver in their reserves. Certainly the only one that's been buying, that's reported. and been buying. But you don't have these large stockpiles of silver. And because silver is a byproduct, most of it is actually sold immediately, and a lot of it is hedged. So the tin miner in Bolivia, he doesn't sort of stockpile his silver waiting for a better price. Typically, they hedge that, and the zinc miner in Peru and so on, they hedge that silver production to lower their cost of mining, right? You offset if you have a byproduct, if you use byproduct accounting, you sell the byproduct and reduce your cost. And so that even exacerbates the fact that the silver's already been pre-sold. So you're not going to get large supplies of silver come onto the market to halt the buying. And I think, Grandma Silver, that all came out in 1980, if you remember. People were going through their attics and getting rid of all the silver, which is a bit of a shame. There's beautiful silver all melted down, but you don't have a lot of that anymore. You don't have a lot of that anymore. So yeah, I'm very bullish on silver.
Unlike gold, silver has no large institutional stockpiles waiting to cap prices. Production is typically sold immediately, often hedged in advance, limiting flexibility during periods of rising demand. In past cycles, secondary supply, scrap silver entering the market, helped temper rallies. That source is far smaller today. As awareness grows, retail investors tend to enter silver aggressively and hold tightly, amplifying price moves. If this phase unfolds as previous cycles suggest, silver could experience explosive upside before eventually correcting. The underlying fundamentals point to scarcity, not surplus, making silver one of the most asymmetric assets in the metals complex.